Thank you for making time for this addendum and for tuning in to the most recent Beyond MD episode on whole life insurance. There were several questions from that episode which I would like to address today. To some listeners, parts of that previous episode were perhaps a bit too enthusiastic, and that's fair. My guest, Donnie Mangos, likes whole life insurance, and it's also a core pillar of his wealth strategy. He's also highly knowledgeable on the product and strategy. But I do realize that this is a very complex topic, and it's important to answer questions and discuss some of the nuances in greater depth, all in the spirit of a more balanced discussion. So I would like to tackle this today. And a quick mention, I currently do not have a whole life insurance policy, and I do not get any commissions if people sign up for whole life insurance. So first, let's begin by discussing Assuris. Assuris is a not-for-profit independent organization in Canada that will protect whole life policy holders if the company issuing their insurance policy goes under. So what happens is, Assuris will protect 1 million or 90% of the death benefit, whichever number is higher. They will also protect 100,000 or 90% of the cash surrender value, whichever number is higher. The brief error that we made in the episode was a statement that Assuris has never had to step in since 1989. The correct data is that Assuris was formed between 1989 and 1990, and in its history, it has had to step in 4 times, with each intervention being successful. The last time was in 2012 with Union of Canada Life Insurance. This company had 22,000 policyholders. Assuris fully protected 99%, and the other 1% had 95% protection. The other insurance company failures happened in 1992, 1993, and 1994. Not a great stretch for insurance companies in Canada, but a great stretch if you were cheering on the Pittsburgh Penguins and Toronto Blue Jays like I was. Next, somebody asked a question about cash values in the early years of a whole life insurance policy. Specifically, there was skepticism that a cash value of $93,000 after the first year of $100,000 premiums is impossible. I did a lot of research on this and consulted various sources, and it turns out that cash values of this size are indeed possible. Traditionally, whole life insurance policies were often created with an emphasis on future death benefit. This often meant lower cash values in the earlier years. Now, policies can be engineered, if warranted based on the goals of the client, with an emphasis on early cash value growth, which can reach 90% of the premium after year 1. This can mean a cut in commission for the insurance agent designing the policy, but the important thing is, policy design needs to be aligned with the goals of the policyholder. Policies with higher cash values are typically designed for those who will be leveraging the cash value in the early years to invest the funds elsewhere. But it's important to understand that there may be a trade-off, meaning that policies with high early cash values may not necessarily perform as well when compared to policies designed for estate planning, if the priority is the death benefit for the next generation. The next question that came in was about using the cash value of a whole life insurance policy as collateral for a loan, using this loan to fund part of one's retirement, and then not paying the interest on the loan back. This is a great question. Why would you not pay interest on the loan back? I want to discuss this one in detail. First, the most important concept here is leverage. Everyone needs to understand their comfort with leverage. It's definitely not for everyone. Second, there are 2 sides to this scenario. One deals with interest rates. Conceivably, the loan rate, when the policy is used as collateral, it certainly could be higher than the dividend scale in the whole life policy, and the dividend scale is what dictates policy growth. So if the difference between these 2 rates, the loan rate and the dividend scale, is enough, and perhaps this difference widens over time, certainly a situation could arise where the volume borrowed is approaching the cash value in the policy. And this could be problematic, and it does strengthen the argument for paying back interest, which, in my view, is a fairly logical thing to do. But the second side of this coin is dollar volume. In the scenario that we discussed in the episode, Collateralizing the cash value of the policy happened much later, more than 20 years after the policy started. By this time, the cash value would typically be quite large, and this dollar volume would continue to grow over time and could very well continue to outpace the amount borrowed for life despite a higher loan interest rate. Also, I do want to mention that along with leverage and less conventional approaches like we are discussing, I think it does make sense to be open to the possibility of an audit and to prepare for this accordingly. Next, I want to move on to a critical point. We evolve and we change over time. I can tell you that when my career started, I would tell Seema that medicine is the only thing I could see myself doing. I imagined working until around the age of 60 and generating a steady income through my medical practice. But I'll say that today is very different because I enjoy wearing different hats and using my mind in different ways. Now, I'm already choosing to work a bit less, and as many of you know, I recently dropped down to 4 days a week of radiology. And we are actually spending more while we're young and prioritizing experiences and the memory dividends that come with them. So for other people who are thinking along these lines, a whole life insurance policy may make less sense, especially if you do not feel comfortable using leverage. Although whole life insurance policies are liquid when designed and used strategically, the policy is still a commitment for life. True liquidity, either through your corporate or personal funds, is like oxygen, especially when life is changing and when things are dynamic. Another point I want to make is remember, in the episode, we were discussing premiums of $100,000 a year. Those are high premiums. That equates to 1 million corporate dollars over 10 years. These are very large numbers, which is why I view whole life insurance as a big decision, similar to buying a home. Also, you do not need to go with such large premiums. You go with something that's a good fit for you. And because the way in which we choose to live life may change, as in maybe we're spending more money while we're younger, there is a strong argument to be made for many considering whole life insurance to entertain perhaps smaller premiums. Another key concept that I do want to articulate is that we often frame strategies as an either or. It's corporate investing versus registered accounts. Yes, there may be subtle differences when it comes to optimizations, but the reality is that we often do both. Similarly, we like to compare corporate investing versus whole life insurance. They are not one and the same. I'm at a stage in my life where I love to understand my investments and I enjoy steering them through my corporation. This is in fact one of my current holdups with whole life insurance because this is a product where I would not be able to choose my investments. But for the right person, there may be a role for both. Also, we need to understand that canceling a whole life policy, it's often not ideal. And depending on when this is done, there can be taxable income. How much taxable income is determined by the formula cash surrender value minus the adjusted cost basis, ACB. The adjusted cost basis formula is in fact quite complicated, but we can try to simplify it with premiums minus net cost of pure insurance equating to the ACB. And for a 10-year pay policy, the adjusted cost basis will usually peak around year 10 and decline thereafter. For people who are navigating whole life insurance policies, you don't have to exit. There are 3 other options that you can consider to navigate, and these are called automatic premium loans, reduced paid up options, and premium offset. And I did cover all of these in detail in an Addendum episode that was released in November 2023. So for anyone looking to learn more, I encourage you to check out that episode. So in summary, whole life insurance is complex and it is fascinating. I do see the majority of early career doctors having really no use for whole life insurance because, as I clearly mentioned in the episode, this is a time when we have many financial commitments and liquidity truly is oxygen. The only cases for somebody early career having a use for whole life insurance that I can think of really are if you have a dependent who will be requiring financial support for the rest of their life, Or maybe you've received a large inheritance and now you need to think about tax efficient intergenerational strategies very early on. Or perhaps you're running a business that is earning far more than you are going to need. And again, you'll have to be thinking about some intergenerational wealth transfer strategies. For mid-career doctors, I think whole life insurance can be a tool in the kit. But ideally, once we are making progress in other areas of our life, like corporate investing, registered accounts, and making meaningful mortgage paydown progress. To consider whole life insurance, I also believe that we should have an estate planning need. And then collateralizing policies through whole life insurance to invest and reducing our corporate taxes or to pursue an insurance retirement plan, these are all very possible strategies and these are allowed, but for some people, these may be a secondary consideration. I hope that helps to round out the discussion on this fascinating topic. And of course, I want to give a shout out to everyone who took the time to listen to the episode and everyone who reached out with their thoughtful questions. We will resume normal programming of the podcast tomorrow, Friday, June 5th, where we dive into charitable giving. We'll see you soon. Stay well, stay savvy.